S. Naren, who's CIO of ICICI Prudential AMC, joins in for just not any market talk. He's joined us for a very, very specific purpose, and that is essentially to make sense of what's happening in the mid caps and the small caps, the meltdown there, and how one should be rationalizing the move. It's extended itself out from the start of the year till now. 2017 was a dream year for mid cap and small cap returns, but that quickly reversed from the start of trade in 2018 and has only gotten worse over the last 2 months. Naren, it's great to have you on the show. Thanks very much for taking out the time. I know that you called for the sell-off quite aptly and have been for a large part saying that, post the sell-off, there would be attractive opportunities in mid caps and small caps. Make of it what you will, but analyze it for the benefit of our viewers. How should one be looking at this mid cap meltdown?
See, actually, if you look at it, is it a meltdown where I don't know? I think 1 year returns are pretty good. So 1 year returns being good and meltdown doesn't necessarily tally. See, our base process was that in the period from 2013 to 16, commodity prices had fallen and interest rates had also fallen. And two of the big beneficiaries are mid caps and small caps at a time when commodities fall and interest rates fall. So coupled with that, we had a situation where you had huge inflows into mid and small cap as a category in mutual funds, AIFs, PMSs, etc. With the result that most of the mid and small caps started to have trailing P's of 40 and 50 across sectors, and that meant that the mid and small caps had become seriously overvalued. I think the process of correction of the overvaluation is on, and what we have learned from past experiences is that as fund managers, we want the top to bottom of the cycle to happen in 6 months, but at times it takes 5 or 6 years. So what I believe is that it is too early to call the bottom at this point of time, and we continue to think that relative to large caps, mid and small caps are still pretty unattractive because you have just had a 6-month correction, not a 3-year or a 4-year correction.
Morning, Naren, you're scaring us. Are you hinting that this correction in the mid and small caps is going to last 3 to 4 years by any chance?
It is not that. I think large caps are so attractive relative to mid caps and small caps at this point of time. And if you look at the quantum of money which has come into large cap funds as compared to what has come into mid caps and small caps, there is scope for relative underperformance from here. As a matter of principle, over a long period of time, what I've done is looked at annual reports as and when they come in this season, but you find that in most companies even today, the trailing P's of many of the small and mid caps are all in 30, 40, 50 range. So it's not as if after this correction, mid and small caps have become cheap. And the one point that I want to point out is it is not as if that the market needs to come down like a straight line. I believe that periodically there should be good rallies in mid and small caps, and the market, both mid and small caps clearly 2 days back when we were looking at it, looked very, very oversold. So there was a scope for a good pullback rally in both mid and small caps, as we saw it. But for us to say that after a 6-month correction and not even a 12-month underperformance or 24-month underperformance, we need to say that we have reached the bottom in small and mid caps. I don't think so. That's not the view at this point of time. And in fact, large caps have been meaningfully underperforming all the way from 2013 till now. And if you look at the 4 to 5 year underperformance of mid caps and small caps against large caps, you will find that large caps have meaningfully underperformed, and the last 6 months or 1 year is not an indicator of what has happened in the last 5 years. So that's why as a house, I would say we were about 1 year early in this call, but we held on to the call and now it is working, and I believe that still there is scope for underperformance of mid and small caps against large caps. Having said that, people ask me, what do you do for SIPs over the next 5 to 10 years? We are clear believers in mid and small caps on an SIP basis over the next 5 to 10 years. We think that's the way to go starting now. And we believe that mid cap investing through the SIP route or small cap investing through the SIP route for the next 5 to 10 years is the right way to do long term investing.
Line in this conversation, Naren. If you are looking at investing in mid caps and small caps, now is the time via the systematic investment planning route, SIP route is what Naren has to say. But you know, Naren, every single day we've been asked questions by our viewers saying how much more pain is left. I know on a timeline basis you're saying 2 to 3 years, but you know, could you perhaps give us more evidence by way of what traditionally mid caps see through in terms of a percentage fall, because there's the broad index level fall, which is the mid cap index, and the small cap index, which is what most people map, and then there are these individual stocks which fall, you know, on an individual basis 50-60 odd %. So what is a good benchmark on to see and assess how much of the bloodbath has already kind of played through?
See, actually, the way we look at it is that historically the trailing price to E of mid caps has been lower than many of the large cap indices, and consequently, what I would like people to do is take a stock, look at the trailing PE, then look at their balance sheet, whether the profits are showing up as cash flows or they are going into working capital or only capex. So then you have a good starting point. But if you have trailing P's of 30 to 40 on most companies, or you have most of the earnings going into capex and working capital, I would say still there is scope for correction. And so I would say that it's difficult to time the bottom, but I think the top itself was January. So we are actually I would say just 4 months from the top at this point of time, and to me bottom doesn't happen 4 months from the top. That's how I look at it. Having said that, as I said, if you had to do SIP investing for 10 years, there's no better thing than small and mid caps.
Yeah, absolutely. Point taken, Naren, that you're making the case that there is going to be a time-wise correction as well as a price-wise correction in the broader markets. And now that large caps have just about made the comeback, the outperformance has lasted at just about 4 to 5 months. There's still a lot of steam left to go within the large caps. So as a fund manager, Naren, what is it that you do? Are you already beginning to cull out that list where you've seen a fair amount of price and PE damage within small and mid caps, already starting to nibble in over there? Or do you think right now is the time when you've got to completely focus and concentrate on only large caps, because like you said, they're the ones which are going to really dominate the market in the next few months to come?
So I think we would be trying to nibble in 1 or 2 stocks and trying to trim in maybe slightly more than them even today. Because if you look at it, the quantum of mid caps and small caps and the kind of liquidity those stocks have, it's not easy for a big fund to actually say, I'll come out of all the small and mid caps on one day or something like that. But I would say, yeah, after this meltdown, is there scope for some nibbling to be done in some selects mid cap and small cap? The answer is yes. So how we look at it is there are sectors where there have been positive cycles, and in wherever there has been a big positive cycle, I would say it is not time for nibbling. On the other hand, there are sectors where there has been no positive cycles, and like for example, let's say banks or real estate or something like that. And in those cases, I would say that because the super cycle itself has been so negative, the small and mid caps have corrected a lot, and therefore there are opportunities in sectors where the cycle has not played out, and that is the area where we are looking at nibbling at this point of time. And on the other hand, if we are trying to book profits, there are a number of sectors where there has been a fair amount of big boom, let's say the NBFCs or many of the other cases. And there I think there is still scope to trim even today, because if you look at the stocks, most of them are 600, 700% higher than what they were in 2013.
That continues irrespective of valuations. So that's a fair point. Naren, I have to talk to you about what's happening on the macro side, because there's going to be a linkage there also onto equities. So you've spoken about large caps, you've spoken about mid caps. What about the fixed income market? And we just saw how the 10-year benchmark yield has hit 8%. We heard from the RBI, this is the first rate hike that they've announced in over 4 years, indicating that there could be one or two more in the offing. What does that do for somebody who's saying, okay, I'm hearing Naren, he's talking about SIPs and mid caps, large cap funds seeing a period of underperformance, so there's scope from a value adjusted return perspective there. What's his take on fixed income funds right now?
See, basically that's a very interesting area, because there you've never had a big bull market, and yeah, at least in India. The problem what I have seen by watching fixed income markets is that oil is one of the most important variables. So if oil goes up, yields go up. If oil goes down, yields go down. So if you ask me, the bigger call for which I don't have answers is whether oil goes up from 75 to 100 or comes down to 65 or 60. I think if the oil were to go down to 65 or 60, the best performing asset class would be long duration fixed income. Since at this point of time we are finding it difficult to take a call on oil, we are sticking with accrual categories like credit risk, categories like dynamic duration, categories like short duration. And I would say that these are the categories which seem to be easier to recommend at this point of time, because we don't have a clear view on oil. We don't have a view that oil crashes to 60 or goes to 100. But I do know that if oil were to go to 100, fixed income doesn't perform. On the other hand, if oil were to go to 60, fixed income will perform. So that's why I think even though the fixed income market, no one has made money, I would say it's safer to stick with safety. The equivalent of large caps in equity in fixed income is short duration, credit risk kind of categories, and moderate duration and dynamic duration. So these are equivalent of large caps in fixed income, and these are the categories we are recommending. Having said that, here the valuations are very attractive in the short duration categories, because if you are the kind yield to maturity on many of the shorter duration products has gone up significantly, and therefore valuations have already turned attractive there. So I think those are clear areas to invest money in at this point of time.
So Naren, as I sense it, this is the time to go back to the drawing board and figure out how is it that you're going to portfolio allocate. Because like even in the case of mutual funds, on an annual basis, you're still in the money, but on a 3-month category basis, even multi-cap funds have lost about 1.5%. And I recall that, you've always talked about that don't go over for large caps or small caps, multi-caps is the way to go. How is it that you portfolio allocate now, both between fixed income, large caps, small caps, or multi-caps?
See, as you know, most of the time over the course of the last 6 months, we've been only recommending categories like balanced advantage, because see, neither equity nor fixed income are in a phase where you think you can make mega returns. So, if you are likely to make no mega returns, so it's safer to stick with products which are lower risk products, like the balanced advantage kind of category or equity savings kind of category. And if you want to be slightly more aggressive, choose categories like multi-asset and debt equity categories. So, and we have found that this kind of, I would say, moderate risk-based investing is the way to go at this point of time. And we would say that there may be better times in the future when we can actually recommend more aggressive investing. Because if you look at it on the micro side, we do expect earnings to go up significantly in the next 1 year. The earnings being concentrated primarily in the large cap space and in sectors like banking and I would say areas like select global stocks as well. And consequently, I believe that in this phase where macro is deteriorating due to oil going up, interest rates in the world going up, there is a lot of volatility due to political events. And in that phase, I think there is no need for super aggressive investing. It's better to invest more carefully through the safer categories which the mutual fund industry has than to choose aggressive categories at this point of time. So I am a believer that we are not in a high return environment, and consequently we have this view.
We've had a fairly exhaustive discussion with you, Naren, but we can't help ask you about the health of the banking system. GM Financials is just holding a BFSI conference. It's core to where the economy is headed. We just have the PSU bankers meeting the finance minister to look at the consolidation plan going forward for the segment. NBFCs are expensive, as you pointed out, but there's still interest in those segments. We know what's happening with ICICI Bank, Axis Bank. I mean, the whole system is up for, analysis and discussion. What should be the approach that one should take while investing, within the financial sector?
See, I think one should be cautiously optimistic because, see, the way I look at it is when NPLs are reflected in the balance sheet, that is a safer time to invest than a period like 2010-11 when 2010 when there were no NPLs reflected in the balance sheet. So I believe from a cyclical perspective, clearly we are more optimistic today on the banking sector than we were 7-8 years back. Having said that, there are organizations which require capital. There are organizations which have to reduce the quantum of NPLs that they have. So there are challenges on a stock specific side, but I would say that we are actually in a phase where we are more positive on banking system than what we were some time back. Having said that, the bulk borrowers in the system, like some of the NBFCs and some of the housing finance companies, there I think the cycle is turning more adverse because interest rates are going up and the deposit taking banks are clearly in a better position than some of the bulk borrowers. Between 2015 and 17, I think the bulk borrowers had a very good time. Now the bulk borrowers are going to borrow at much higher interest rates. So I think tactically we are clearly more positive on the banking system and more circumspect on the bulk borrowers in the system.
So Narel, as we wind down this discussion, about a year back, it was the alarm that you sounded off for the broader end of the market. A year down the line, what is it that you think is going to be that one defining trend that we're going to witness in equities?
Unfortunately, it is volatility over the next 1 year with US increasing interest rates, US 10-year going up, oil going up, leading to current account deficit increase in a country like India, and political events. I think if I look at the broader trend for the next 1 year, it is going to be volatility, and periods of time when markets are volatile are more difficult times to trade for some of the traders. And on the other hand, for people who are looking to do long-term investing through the SIP route, periods like volatile periods are very, very good times. So I think for the mutual fund industry, which is focused on moderate risk categories and SIPs, I think it is a very good time, but I would say that traders have to be very careful over the next 1 year because the market conditions are likely to be reasonably volatile and they could suddenly have big moves both on the up and down side. So I would say traders have to be much more careful, and investors should slowly invest for the long term in periods of time when volatility increases. This is the broad message that we have.
It's been such a pleasure speaking with you this morning, and like I said, I think for all those people watching the screen and seeing mid caps and small caps melt away or seeing significant selling pressure there, the headline really is S. Naren's message: start your SIPs at least in that space for now.
And he says it's not a meltdown just yet. We've not seen the worst of it.
Of course, we've only seen 6 months of it, but for an investor, for a viewer out there quizzing the screen, well, SIP is your way to getting into mid caps as well as small caps. But tell you what, we've also done some deeper analysis, done an extensive poll in understanding what's happening in the broader markets from some of key market veterans who especially have made large sums of money, have created a lot of wealth by investing in value-backed mid caps over decades. So what my colleague Ajay Sharma did was touch base with a whole lot of them and drew up some conclusions on how to approach investing in the mid-cap space. Ajay, I'll let you take it over and share with our viewers your findings.
Well, that's correct. What we've actually done is that we've touched base with some of the participants in the market who have been investing in mid-caps over cycles for almost 2.5 decades now. And we've tried to get their reactions going, because many of the rare ones we have got to speak with, people like Rajiv Khanna, who's also known as Dolly Khanna, Mukul Agarwal, another mid-cap, that's Dolly Khanna's mug for you, but it's Rajiv Khanna who actually does the, stock picking, and people like Mukul Agarwal, another rare individual, does a lot of investing in mid-cap, doesn't come on TV. People like Porinju, of course, Ashish, Basant, Maheshwari. Ashish Chugh can clearly be called one of the early small-cap, mid-cap investors. At least we've been interacting for almost 10-11 years, but doesn't come on the channel. And what one is understanding from talking to them is that people over the last 3-4 years had kind of forgotten and had started taking it slightly lightly what kind of risks are associated with mid-cap and small-cap investing. The sharp volatility, the pace at which it loses value as well the moment markets turn volatile, and that's exactly what is happening. Mukul Agarwal says that this is a time to hold on to high conviction bets right now. One should not panic and exit at sharp stop losses. Areas where you've done deep research and are convinced, hold on to them. Those stocks will actually come back. Similarly, Rajiv Khanna says that this is a small rebound which we are seeing in the mid-cap, small-cap right now, but the way space has got shaken, this rebound will actually fade into and may not be very sustainable. Actually, Rajiv Khanna also told me that the next 6-7 months there'll be a lot of volatility, be it election-led, be it global cues led, and that volatility should be utilized to get back into high conviction ideas which the prices have come down and you would want to average into. Also, Ashish Chugh says that value has started to emerge in several areas of the market, and this is the time to dip your feet. Porinju says that majority of the mid caps may not come back, but it is very normal that after 5 good years, a couple of months turn out to be rough, and these are the times when you start building your portfolio once again. So the message is clear that people who have been in mid cap, small cap through cycles are taking note of what has happened. They believe that this spell of weakness may be slightly more prolonged, but that doesn't mean that you completely abandon the space. Keep doing your research and average on high quality names on the downside, and more importantly, hold on to your high conviction bets. It's a cyclical space, couple of good years backed by some weakness, and that is what is happening right now. And money will come back to the space maybe after a gap of 6-8 months.
Well, plethora of opinion coming in from some of the most popular market faces. Ajay, thanks for collating and chatting with all of them to really make sense of this mid-cap mayhem. And that's really an extension of the view that we just got from S. Naren from ICICI Pru AMC, saying that this is not it. Don't be fooled by the rebound in the broader markets that you've seen in the last 2 days. There is much more pain left to go, and volatility, that's going to be the key trend for the next few months to come.